We're joined now by Cornelia Meyer in Geneva. She's an economist and CEO of Meyer Resources. Welcome back to the programme, Cornelia. Now, this hike is meant to tame inflation driven entirely by higher energy prices. So what does raising borrowing costs actually fix? A broken energy supply or reopen the Strait of Hormuz?
Well, good morning, Taibe, and thank you so much for having me. Well, the ECB's sole goal is to keep inflation at 2%. So whenever it goes higher, they need to look at it, and the inflation rate has really gone up over the last 2 months. So that's why they reacted. As you rightly pointed out, they reacted too slowly in 2022 after the Ukraine war started. However, they acted too fast and too much in 2011, and Trichet hiked rates, and then Draghi had to take them down. They have a difficult spot because, on one hand, they need to look at inflation. On the other hand, they need to look at the growth rates in the Eurozone, and the Eurozone contracted by 0.2% in the first quarter.
Now, European businesses are already reporting that they plan to raise their selling prices to survive. So if this rate increase fails to cool down domestic corporate price hikes, what's the ECB's plan B?
Well, it's interesting because all analysts are looking at it, and we're asking ourselves, is this a one and done? One rate hike and done, or will there be another one? And you saw that the German head of the Bundesbank said, well, he thinks it's good for now, but then you saw the Slovenian head of their central bank saying he thinks there might be another one in there. So at this point, they were unanimous. There will be debate going forward.
And as mentioned back in 2022, critics slammed the ECB for being way too slow to react to that energy shock. So can we also see this move as an insurance policy to fix its past reputation?
Well, institutions learn from their mistakes. And I think in 2022, they learned from the mistake of having overdone it in 2011 and hiked too quickly, too much. And now they're sort of looking at, oh, we didn't go fast enough, so let's go fast. So let us see. And as I said before, it's not easy. Being a central banker is not easy. You need to weigh your goal of inflation versus how the economy as a whole is doing. And obviously, if it's contracting, higher interest rates are not helpful.
And there seems to be an unwritten rule in global finance that the Fed moves first and then others follow. Is the ECB acting too soon out of panic, or are the Fed and BOE simply moving too slow?
No, I think you need to look at it. It's horses for courses, right? The ECB, Europe is closer to the Middle East and therefore more affected. The Asian markets are even more affected, and we will have a new Fed governor also coming in, and he will probably, everybody says, he will not hike rates right now in his first meeting, which happens first FOMC, which happens next week. And, you know, he has a president who doesn't want him to hike rates. So we're in a different situation than an ordinary situation. Everything with this presidency, the second presidency of President Trump, everything is a little bit different than from what you're used to.
Cornelia Meyer in Geneva, thank you very much as always.
Thank you very much indeed.